Before I buy any stock, I run through a checklist. If it's even one of these red flags, I don't touch it. I've been investing for over 8 years and I've turned 20,000 into seven-figure portfolio by investing in stocks, trading options, holding crypto long term. And in that time, I've made every mistake you can make. And I bought stocks that crashed. I've held losers for too long. I've ignored warning signs. These five red flags, they're a checklist I use to avoid these mistakes now. And they've saved me from losing tens of thousands of dollars in bad companies. And if you're picking individual stocks, you need to know them too. Let's jump in. Red flag number one is declining revenues. Not declining profits, it's declining revenues. Revenues top line. It's how much money the company is bringing in from sales. And if that number goes down year over year, there's a problem. Because declining revenue means people are buying less of what they're selling. Maybe the product's outdated. Maybe there's more competition. Maybe the industry's dying. Whatever the reason, if a company can't grow or even maintain its revenue, that's a huge red flag. Now, I'll give you an exception. If the company is intentionally shrinking to focus on profitability, that can be okay, but that's rare. Most of the time, declining revenue just means that pull up their earnings report, look at the revenue over the last 3 to 5 years. Is it growing? Is it flat? Is it declining? If it's declining, I'd recommend moving on. Number two, too much debt. Debt isn't always bad. Companies use debt to grow, but too much debt, that's dangerous. I'll look at debt to equity ratio. It tells you how much debt there is for a company compared to its equity. If a company has a debt equity ratio above 2, I'd be wary. If it's above 3, I'm typically out. Why? Because when times get tough, recession, market downturns, whatever, companies with massive debt loads get crushed. And they're paying interest instead of growing, instead of investing in their growth. And they're at risk of defaulting. Looking at what happened in 2020, a lot of these companies that had low debt survived and even thrived, and a lot of companies that had too much debt, well, many went bankrupt. And how to check this is most finance sites will show off a debt to equity ratio. If it's not there, you'd want to look at the balance sheet, and then you'll go total debt divided by total equity. Red flag number 3, heavy insider selling. So if the CEO, if the CFO, if board members are selling, dumping their shares, that's not a good sign. Now, insiders sell stock for a lot of reasons. They're exercising options, that's normal. But when you see multiple insiders selling, large amounts all at once, none of them are buying, that tells you they don't believe in the company's future. If you ran a company and knew it was about to blow up in a good way, would you be selling shares? No. You'd be holding, maybe even buying more. There's a few ways to check this. One route is the SEC's website. Another website is called Open Insider. And you could look at transactions over the last 6 months. If there's heavy selling across the board, that's a big red flag. Number 4, negative free cash flow. Free cash flow is cash a company generates after paying for its operations and capital expenditures. It's the money left over. It's similar to how most folks can use the word profit. If a company consistently has negative free cash flow, that means it's burning more money than it's making. A company can show profits on paper but still run out of cash and go bankrupt. If a company isn't generating cash, it has to either take on more debt or raise more money by issuing shares. A lot of companies like Amazon, Google, Meta, a lot of their stocks are going down because they've projected 160, 180, 200 billion dollars in spend, which lowers their free cash flow. Obviously, these companies are still amazing companies, but they're going to have less free cash flow. this next year compared to their other years. So that's how important companies should be valuing free cash flow. Early stage companies might have negative free cash flow. They're investing heavily in growth. That can be okay as long as there's a path to profitability. But if it's an established company and it's still burning cash, I'm more so going to pass on that. How to check this is look at the cash flow statements on their earnings report. Find free cash flow. Is it positive? Is it growing year over year? Number 5, no competitive advantage. This is also called a moat, like that ring of water around a castle. It's what protects the company from competition. Ask yourself, what does this company have that competitors can't easily copy? Is it brand? Apple, Coca-Cola? Or is it the network like Meta or Facebook or Visa and MasterCard? Is it proprietary technology? Is it low cost production? Some folks say right now AI is going to take over software. Adobe, Salesforce, ServiceNow, because you can go and create an image very easily. But most folks don't understand Adobe and its business model, that it's integrating AI. Overall, if the answer is nothing special, that's a red flag because it's a competitive market and profits get squeezed, prices get dropped, margins shrink, and you as a shareholder will suffer. I avoid most retail stocks for this reason. What's stopping a new competitor from opening up a similar store? But a company like Microsoft, they have network effects, switching costs, brand loyalty. That's a moat. So one way to check this would be just by asking yourself, could a startup with funding replicate this in 5 years? This one's more subjective, right? So it's kind of a gut feeling or reading about the company. But if you can think that a new company can just start up in 5 years, be as effective as that current company, then I'd probably stay away from that company. Quick recap, the 5 red flags that I look for: declining revenue, debt, heavy insider selling, negative free cash flow, and no competitive advantage. If a stock hits one of these, I dig deeper. If it hits 2 or more, I'm going to move on. There are thousands of stocks out there. No reason to pick a risky one. What's your number 1 red flag when picking stocks? Drop it in the comments below. And if you found this helpful, subscribe. I'm breaking down real investing strategies multiple times a week. Next video, a market recap where I'll walk through things that have happened this last week and what I'm watching for. See you there.